Hey guys, welcome into another YouTube video. This is just a quick one. I'm talking about the 4 ways to profit from property investing. First one is cash flow. So cash flow is the rental income minus your expenses. This is the amount that you'll receive into your account that you won't have to spend on costs associated with the house. Cash flow is good for providing income to the bank so that they can allow you to borrow more money in order to buy the next property. New Zealand isn't the best for cash flow, relative to other countries anyway. There's a lot of other countries that you can get much higher cash flows than New Zealand, but over the past few years, New Zealand has been the biggest for capital gain or market appreciation. In New Zealand, we would have to resort to higher risk areas or multi-units or multiple income stream properties in order to cash flow positive. If you look at like the riskiest suburb in each city, they're pretty much always going to have a higher rental yield than the rest of the city. And the opposite, if you look at the best suburb in the city, it's almost always going to have the worst rental yield. Market appreciation, so this one's the most commonly talked about one in New Zealand and the most prevalent. Because of how the housing market's just been going crazy in recent years, most specifically the last year. Capital gains have been insane for anyone who's owned property in that time. So this can be untaxed if you wait out the bright line duration for your property. Depending on when you bought your property, the bright line duration will be different. For my house, I have a 5-year bright line duration. So I have to wait 5 years from when I bought it to when I sell it in order to avoid paying bright line tax. There are other ways to trigger bright line tax, which bright line's essentially New Zealand's capital gains tax for property. Only the government didn't want to call it a capital gains tax because it's bad publicity, I think. There's a lot of ways you can actually trigger it, so you've got to be careful. Like if you say have 2 houses on one title and then you separate them out and make it into 2 titles, then you're probably looking at resetting the bright line duration, certain weird things like that. So be careful. Contact accountants in order to know what you're going to trigger. This is the least predictable way to make profit from a property. It's essentially a lot of hoping and waiting. So market appreciation, you can't fully predict it. Like in New Zealand, it's almost been taken for granted that property will always go up, but it's really not the case. Like, it can go down. If you look back in history, like it has gone down for multiple years, but over the long run, generally speaking, it has always gone up. But it's the least predictable. Like over the next year, where will property prices go? I have no idea. I don't know if they'll go up, down, sideways. So the other forms of profiting from property, the other 3 that I mentioned, they're all way more predictable, and you can pretty much calculate exactly what they're going to be before you buy the property, but not market appreciation. It's an unknown factor. So renovation or gained equity. So renovation equity can be renovation equity can be calculated by comparing recent sales of houses in the area that are similar to the current conditions of the house, and then comparing to houses in a condition that you'll renovate it to. So you look for houses that have sold recently that look like the house you're buying, and then you see what they're going for, and then you look at a house that's been renovated recently, how much that sold for. Obviously it has to be similar to that house and how it's going to look when it's finished. And then the equity gain between the 2, and then you have to make sure that your renovation budget and all the other like closing costs and stuff fit between that. Next, the best way to make the greatest equity gain from renovating is to do all the work yourself, or have friends and family who are qualified assist you. In New Zealand, if you try to do this by paying professionals to do the work, you'll probably end up losing money. But if you plan to have professionals do the work, make sure you plan out all the financials beforehand. Make sure you know how much everything's going to cost, and you make sure that you only offer the amount for the property that you know you can still get the work done and still make a profit. Otherwise, it's super easy to lose money from paying professionals, and they will try and upsell you. I've seen it a few times. I'm only 24. I haven't seen many property renovations and stuff, but I've seen certain projects that you get them in to do a renovation. You think it's not going to be too expensive, but they're like, "Oh, would you like this upgrade and this one and this one?" And it ends up costing a lot more than you initially anticipated. But it's always going to be a lot more expensive to have a renovation done by professionals than it is to do it yourself, but obviously you're also paying for quality, so there's that trade-off. Mortgage paydown. So this is the amount of the mortgage payment that goes towards paying down your overall mortgage balance. So it's fully taxed, as it's essentially cash flow. If you're on an interest-only mortgage, there would be no mortgage paydown. So this is all assuming that you have enough rental income to cover, like you're either cash flow neutral or cash flow positive, and then the rent you're getting pays your mortgage for you. You still have to pay tax on that, so got to calculate that in. But unfortunate, but it does make sense. I believe it's the safest to be on P&I loans, or principal and interest loans. That way, over time, you own more and more of the property, which gives you options. If you can refinance out to 30 years again, say you're down to a 20-year mortgage because you've been paying it for 10 years, you can refinance to 30 years, and that'll increase your cash flow. Say if you retired, like you're deciding to retire early at 40 or something, you refinance out to 30 years, then you'll increase your cash flow because your mortgage payments will be a lot less. You can also refinance equity out of the property. So you're up to like 60-70% equity. If you refinance, you can take it all the way back down to 40 if it's a rental property, or 20% if it's owner occupied. So the combination effect of using multiple of these methods is pretty powerful. So some of these methods can assist you in achieving others, like cash flow. In order to purchase more property, the more cash flow you have, the more banks would like to loan to you. Or renovating to sell for a capital gain, so you could buy a house that doesn't cash flow well, that you're purely buying because you can see there's a big equity difference between how it is now and how it'll sell for when it's fully renovated. So you can buy it, renovate it, sell it again, also known as flipping, and you make some money. You have to pay tax on that money, but you have some money in order to get a deposit on another property, or to increase the cash you had to put down for deposits. And then that'll allow you to buy more houses. So you could then go and buy a cash flowing house that would allow you to borrow more as well. So a combination of these, or all four, will probably be the best approach to property investing for most people. Some people like to focus on only one, like a lot of in New Zealand we refer to them as property speculators. People who just keep buying up property in Auckland thinking the prices will just keep going up and up and up. And so far they haven't been wrong, so there's a bit of a survivor's bias going on, but maybe one day the market will take a downturn, and I imagine a lot of those fully leveraged people will be hit quite hard. Just depends kind of when they got in the market. If they've been in the market for a while, they probably won't have too much of an issue because they would have had quite a lot of gained equity. But if they've just gotten in at like the highest point, they could look at having a loan bigger than the current value of the property if there was a downturn, which would be a bit unfortunate for them. That's all I got for this video, so thanks for watching. Subscribe if you want to see more videos. Leave a like to support the channel, and I spelled channel wrong. Leave a comment for any video ideas, and yeah, have a great day. See ya.